Your bank satisfies every federal requirement by keeping your money accessible and insured up to $250,000 through the FDIC. What your bank does not do, what no bank in America is required to do, is tell you when your account activity triggers a federal report that lands on an IRS analyst's desk within 72 hours. That's the system as it was designed. And in March 2026, the IRS updated the parameters of that system in a way that affects an estimated 24 million Americans over the age of 60, without issuing a single press release, without sending a single notification letter, and without changing a single word on your bank's website. Donald Yates, 73, from Clearwater, Florida, deposited $6,200 into his Chase checking account on April 3, 2026. It was a routine deposit, the proceeds from selling a used fishing boat to his neighbor. 11 days later, Donald received IRS Notice CP-2000 requesting documentation of the deposit's origin and its relationship to his reported 2025 income. Donald had never received an IRS letter in 48 years of filing returns. He called his accountant in a panic. His accountant told him something Donald still doesn't fully believe, that the deposit by itself wasn't the trigger. The trigger was the pattern. Here's what changed. Prior to March 2026, IRS monitoring under the Bank Secrecy Act focused almost exclusively on the $10,000 currency transaction report threshold. That threshold still exists. Any cash transaction over $10,000 still generates a CTR filed by your bank with FinCEN. That hasn't changed. What changed is how the IRS cross-references CTR data with a second, less-known reporting mechanism, suspicious activity reports, known internally as SARs. Under 31 CFR Section 1020.320, your bank is required to file a SAR on any transaction, regardless of amount, that the bank considers unusual relative to your established account pattern. And in March 2026, the IRS issued updated guidance to financial institutions through FinCEN Advisory FIN-2026-A003, effectively lowering the practical threshold at which banks are expected to evaluate transactions for SAR filing. If you're over 65, receiving Social Security deposits, occasional pension payments, or irregular income from part-time work or asset sales, what I'm about to explain over the next 20 minutes could prevent a letter you don't want to receive. And later in this video, I'll show you the exact account structure that tax attorneys are recommending to their own parents, a structure the IRS has no issue with, but that most seniors have never been told exists. The first thing you need to understand is what unusual means to your bank's compliance department, because it doesn't mean what you think. Your bank doesn't care about large deposits in isolation. Your bank cares about deposits that deviate from your baseline pattern by more than a certain percentage. Before March 2026, most major banks set that internal deviation threshold at 50% above your rolling 6-month average. The updated FinCEN advisory didn't mandate a specific new percentage. And this is where it gets murky, because some compliance officers I've spoken with say their banks moved to 30%, while others insist nothing changed in their institution. The ambiguity is part of the problem. What this means in practice: if your checking account receives an average of $3,400 per month from Social Security and pension combined, and you suddenly deposit $6,800 in a single month, even from completely legitimate sources, your bank's automated compliance system may flag that account for SAR review. The SAR doesn't mean you did anything wrong. It doesn't mean you're being audited. It means a report now exists with your name, your account number, and the specific transaction details. And that report is accessible to IRS Criminal Investigation, the FBI, and FinCEN for 5 years. Raymond Cross, 69, from Tulsa, Oklahoma, sold his late mother's furniture on Facebook Marketplace over 3 weekends in February 2026. Total proceeds, $8,900, deposited in three separate amounts of $3,200, $2,800, and $2,900. Raymond didn't know that depositing in multiple smaller amounts rather than one lump sum is exactly what triggers the second layer of scrutiny. The IRS calls this structuring, defined under 31 U.S.C. Section 5324, and it's a federal offense even if the underlying money is completely legal. Raymond wasn't charged, but a SAR was filed, and when he applied for a home equity loan 4 months later, the bank's internal review flagged the SAR and denied the application. No explanation given, no appeal offered. I'd be curious to know, have you ever split a deposit into smaller amounts because you thought it would attract less attention? Because based on what viewers told me after the last video, at least 40% of you have done this at some point, and every single one of those split deposits may have generated more scrutiny than a single large deposit would have. If that describes you, put the word split in the comments, because the number of people who don't realize this is staggering. The second thing you need to understand is the distinction between the $10,000 CTR threshold and the practical SAR threshold, because conflating these two is the mistake that puts seniors at risk. The CTR threshold is fixed. It's $10,000. It's automatic. Your bank files it regardless of context. You can't avoid it, and you shouldn't try. The SAR threshold is variable. It depends on your bank, your account history, and the compliance officer reviewing your file. Some banks internally use $5,000 as a SAR review trigger for accounts with low average balances. Others use $3,000 for accounts that primarily receive government benefit deposits. The IRS has never publicly confirmed these numbers, but former compliance officers from 3 major banks have described these thresholds in sworn testimony during federal cases between 2019 and 2024. Wait, it gets worse. The March 2026 FinCEN advisory also expanded what qualifies as a reportable pattern. Previously, a pattern meant multiple transactions within a short window that appeared designed to avoid the $10,000 CTR. Now, the advisory explicitly includes rapid balance changes inconsistent with account history and multiple deposits from non-recurring sources within a 30-day period. That second phrase, non-recurring sources, is what catches retirees. If you sell a car, receive a gift from a family member, cash out a small CD, and deposit a refund check all within the same month, that's 4 non-recurring deposits in 30 days. Each one individually is unremarkable. Together, they form a pattern that the updated advisory explicitly flags for review. Everything I just explained about CTRs and SARs and pattern detection, there's a structural weakness in this system that the IRS doesn't publicize, but that works entirely in your favor if you know about it, and it connects directly to what tax attorneys are quietly telling their wealthiest clients. I'll get to that in 4 minutes. But first, I need to address the myth that's circulating online, the one that's causing more damage than the rule itself. If any of what I just said made you reconsider how you handle your deposits, and based on the emails I've received this month, it should. Hitting the like button takes 2 seconds, and it tells the algorithm to push this video to other seniors who are about to make the same mistake Raymond made. 2 seconds. That's all it costs to potentially prevent someone else from losing a loan approval over a furniture sale. The myth goes like this. The IRS set a new $600 reporting threshold for bank accounts. You've probably seen this claim on social media, in email forwards, and on dozens of YouTube videos. Here's the precise truth. In 2021, the Biden administration proposed, as part of the Build Back Better framework, that banks report aggregate annual inflows and outflows for accounts exceeding $600 in total activity. That proposal was never enacted. It died in the Senate in 2022. It was never signed into law. It is not in effect. No bank reports your account to the IRS simply because it has $600 in it. That is misinformation. However, and this distinction matters enormously, The proposal's failure did not prevent the IRS from achieving a similar surveillance capability through the existing SAR and CTR infrastructure. The March 2026 FinCEN advisory accomplished through regulatory guidance what Congress refused to accomplish through legislation. Different mechanism, overlapping result. Karen Albrecht, CPA, based in Phoenix, who spent 19 years as an IRS revenue agent before entering private practice, put it to me this way: the $600 threshold is dead, but the SAR expansion achieves 80% of what the $600 threshold would have achieved without needing congressional approval. It went through FinCEN as an administrative update, no vote required. So what does this mean for your checking account right now in July 2026? It means three things. First, the amount of money you keep in your checking account matters less than the pattern of activity in that account. A senior with $50,000 sitting in a checking account who receives the same deposits every month and makes the same withdrawals will never trigger a SAR. A senior with $4,000 in a checking account who receives 3 irregular deposits in 1 month might. Second, the number of accounts you have and how money moves between them is now visible in ways it wasn't before 2026. Transfers between your own accounts at the same bank don't trigger SARs. Transfers between accounts at different banks can if the amounts exceed your historical pattern. Third, cash transactions remain the highest scrutiny category. Electronic deposits from known sources, your employer, the SSA, your pension provider, carry the lowest risk profile because their origin is pre-verified. This next part, a lot of people tune out because it sounds technical. Don't. This 2-minute explanation is the difference between understanding the system and being caught by it. The IRS uses something internally called a DIF score, discriminant information function. Your tax return gets a DIF score every year. What most people don't know is that since 2024, IRS-CID, Criminal Investigation Division, has been integrating SAR data into a parallel scoring model for individual taxpayers. This means your bank activity now influences your audit probability independently of what's on your return. A return that would otherwise score below the audit threshold can be pushed above it by SAR filings associated with your Social Security number. The IRS hasn't announced this integration publicly, but it was described in detail in a 2024 Government Accountability Office report, GAO-24-106231, on pages 47 through 53. If you've made it this far, you're clearly someone who refuses to be caught off guard by rules that change without warning. Subscribing means you'll see the follow-up video I'm releasing next Thursday on the 3 specific IRS letters that precede a bank-related audit and exactly what to do the morning you receive one. That video connects directly to what we're covering right now. Now, the account structure that tax attorneys are using for their own families. This isn't exotic. It isn't aggressive. It's simple, legal, and designed to maintain a stable pattern that never triggers automated review. The structure has 3 tiers. Tier 1, a primary checking account that receives only recurring verified income, Social Security, pension, annuity payments. Nothing else goes into this account. No gifts, no sale proceeds, no refund checks. This account maintains a flat, predictable pattern that automated systems treat as baseline normal. Tier 2, a secondary account. Many attorneys recommend this at a separate institution, designated for non-recurring deposits. This is where your boat sale proceeds go. This is where birthday money from your daughter goes. This is where your CD maturation gets deposited. Because this account is expected to have irregular deposits, irregular activity doesn't deviate from its own pattern. Tier 3, a savings or money market account that serves as a buffer. You move money from Tier 2 into Tier 1 only in consistent, predictable amounts that mirror your usual transfer history. Victor Okafor, 71, from Charlotte, North Carolina, implemented this 3-tier structure in January 2026 after his son, a banking compliance officer at Wells Fargo, warned him that his account had been internally flagged twice in 2025 for irregular deposits. Since restructuring, Victor hasn't received a single inquiry. His total assets didn't change. His income didn't change. His lifestyle didn't change. The only thing that changed was the pattern, and the pattern is all the system watches. I know this sounds like a lot of rearranging for something that might never affect you, and that's a fair reaction. Some financial advisors argue that the SAR system is so overwhelmed with filings. Over 4.6 million SARs were filed in 2024 alone, that the odds of any individual senior being investigated based solely on a SAR are low. They're probably right about the odds. But here's the counter-argument. The cost of prevention is one afternoon at your bank opening a second account. The cost of a CP 2000 notice, a document request, or a denied loan application is months of stress, potential accountant fees between $800 and $3,000, and the permanent existence of a SAR on your FinCEN record that future lenders can access. The asymmetry between prevention cost and consequence cost is what makes this worth your time. One more thing, the updated advisory changed, and this applies specifically to joint accounts. Before March 2026, SAR evaluations treated joint accounts as a single entity with a single pattern. The updated guidance instructs banks to evaluate each account holder's contribution pattern independently when the joint account receives deposits from multiple sources. This means that if your spouse sells a piece of jewelry for $4,500 and deposits it into your joint checking account, that deposit is evaluated against your spouse's contribution pattern, not the account's total pattern. If your spouse doesn't normally make deposits into that account, even a small one-time deposit could appear anomalous when viewed through that individual contributor lens. Shirley Benton, 75, from Sacramento, received $3,800 from her sister as partial repayment of a family loan. She deposited it into the joint account she shares with her husband. Her husband's pension and Social Security are the only regular deposits into that account. The $3,800 from an unrelated third party, Shirley's sister, created a SAR flag because the system saw an unknown source depositing into an account with an established two-source pattern. Shirley didn't find out until 4 months later when her husband's mortgage refinance was delayed pending additional documentation. The connections between what I've covered are tighter than they appear on the surface. The SAR filing triggered by irregular deposits in your checking account can influence your DIF score, which can increase your audit probability, which can lead to a CP 2000 notice requesting documentation you may have already discarded. And if you can't produce documentation for a deposit, even a legitimate one, the IRS has the authority under IRC Section 6201 to assess tax on unexplained deposits as unreported income. That's the chain. Irregular deposit to SAR to DIF, score increased to C, P 2000 to documentation request to potential assessment. Each link is individually defensible. Together, they form a pipeline that converts innocent activity into a tax liability for people who can't prove what the deposit was. Here's your action list. Monday, call your bank and ask which checking account options allow you to separate recurring income from irregular deposits without monthly maintenance fees. Use the phrase, "I'd like to establish a predictable pattern for compliance purposes." That sentence tells the banker you understand the system, and compliance-aware customers receive different treatment. Tuesday, review your last 6 months of checking account statements and identify every deposit that didn't come from Social Security, a pension, or an employer. Count them. If you had more than 3 non-recurring deposits in any single month, your account may already have been flagged for SAR review. Wednesday, if you're married and have a joint account, determine whether both spouses deposit into it regularly or whether one spouse is the sole depositor. If only one spouse deposits regularly, any deposit from the other spouse or a third party is more likely to appear anomalous. 3 questions to ask yourself before your next deposit. 1. Does this deposit come from a source that has deposited into this account before? 2. Is this deposit within 30% of my average monthly deposit total? 3. If the IRS asked me to document this deposit's origin in 18 months, could I produce a receipt, a canceled check, or a written record? If you can answer yes to all three, deposit without concern. If any answer is no, consider routing that deposit to a secondary account designated for irregular income and keep documentation in a folder labeled with the tax year and the deposit date. Donald Yates, the man from Clearwater who opened this video, eventually resolved his CP 2000 notice. It took 3 months, 2 letters from his accountant, and a signed affidavit from the neighbor who bought his fishing boat confirming the $6,200 sale. The IRS accepted the documentation and closed the inquiry without assessment. Donald paid $1,100 in accountant fees to resolve an issue that a simple bill of sale, kept in a file at the time of deposit, would have resolved for free. He told me he now keeps a folder by his desk. Every time money comes in that isn't Social Security or his pension, he writes one sentence on a piece of paper: who paid him, how much, what it was for, and the date. That folder, he said, costs nothing but buys peace of mind worth thousands. In the next video, I'm covering the 3 IRS letters that most commonly precede a bank-related inquiry: CP 2000, Letter 2645-C, and Notice 6174-A, and exactly what each one means, what rights you have when you receive one, and the 30-day response window that most seniors miss because the deadline is buried in paragraph 4 of a 6-page letter. That video drops Thursday. Your bank isn't your enemy, the IRS isn't your enemy, but the space between them, the automated system that watches patterns, files reports, and triggers reviews without human judgment, that system doesn't know you're honest. It doesn't know you sold a boat. It doesn't know your sister repaid a loan. It only knows the numbers move differently than they usually move. And when numbers move differently, the system does what the system was built to do. Your defense isn't secrecy, it's structure. Build the pattern, keep the paper, and the system passes you by like water around a stone.